As it gets to the discussion about building better and more durable portfolios and the inhibitors for advisors doing that, would you speculate why, for example, there isn't more money invested currently outside of U.S. markets?
Yes, I mean, this has been an issue for a long time, what we call home bias in the investment management business. People like to invest in what they're most familiar with. But what we see is, looking overseas, the global economy is actually growing faster than the United States right now, and there are plenty of opportunities overseas.
The synchronization of global growth right now is pretty exciting.
I think one of the problems we particularly have in America, and this is less of a problem elsewhere, is that Americans get a very narrow and filtered view of the world. We have this idea that there's chaos elsewhere in the world, when in fact, most of the best money is made in boring places. And there is a lot of opportunity overseas. So I think, again, we have to constantly fight against it, remind people that, in fact, there are plenty of opportunities overseas.
Be an objective champion for the consumer, identifying areas that they should be invested in, that they by themselves might not see.
We've got to remind people that, what you want to do is diversify away from your stream of income, not concentrate your wealth and your income in the same place. If you even think about your total assets, and I think Joe, you're talking about looking at the total picture. If you have a house in Michigan and you work for an auto company and you own auto stock, you've got 3 levels of exposure.
Crazy. But David, if you talk to a client about that, that really means something to them, and they appreciate when you point that out. So it's not something that they really thought about. Advisors need to be well-trained. They need to be experts. I tell the young people in our firm all the time, if you don't have the right answer and you're giving people the wrong advice, you can ruin lives in this business. And so I think that it's technical competence, really being an expert, and also always really connecting with your client.
The human advisor will win if they understand their clients better than anyone else. That's the bottom line.
One way that I think you can get people to be more longer term in the equity market is if you set up a bucket strategy for them. So what we do is we'll put the liquidity needs in one bucket with very, very short-term bonds or money market funds. And then the intermediate bucket will be maybe bonds 3 to 5 years, and that will be 3 to 5 years of their liquidity needs. And then you put in the third bucket, the longer-term bucket, your equities, your growth assets, so that if you discuss with a client, here's what this is for, here's what this is for, here's what this is for, they have a lot easier time being patient with the ups and downs of the market.
And then when the markets do well, you replenish from the long term and replenish maybe a couple extra years. So right now it would be, instead of having 5 years, let's make sure we have 8 years, because the markets might not be that great. It is a very powerful way for individuals to just make the right decisions.
And one of the things I think that happens in our industry is that advisors will not have those kind of tough discussions with clients. It's just easier not to. It's easier just to, have these surfacey discussions about the investments. It's the complacency, I know.
And some advisors are too afraid to be the arbiters of truth because the guy down the street is telling them they don't need to worry about it. They've got plenty of money. They'll be fine.